Okay, good afternoon, guys. Welcome to another live trading session with me, Steve Ruffley. So what we're going to do today is look at the GDP in the US and see how that affects the markets. Very difficult to pick out in spectrum of fundamental. Now you have to remember China being the next big economy, the emerging markets, all this kind of stuff, and it's fine. It's fine to talk about that kind of thing, but the true fact of the matter is that when you talk about China, the GDP per head is $5,500. In the US, it's $45,000. So it doesn't matter how many people China has. Per person, they're worth less money. So when we talk about what moves the markets, what's important, it's all the things out of the US. So right now, we're focusing on the growth figures. We know that inflation is in the UK especially, is above target. But what we're looking for is indicators and cycles that the UK is getting itself out of, the downturn, and that's being stimulated by growth. Personally, I think it's a bit of a tricky situation, to be honest. The fact that, some of the major companies in the UK, US, and Europe are sitting on some of the biggest amounts of deposits they've ever had, cash deposits. In some cases more than individual countries. And they're not giving that to employees, not really giving that to, the tax system. We're in a bit of a funny situation right now. And something will have to give. I mean, it doesn't take, Steve Ruffley to tell you what's going to happen. But the fact of the matter is that something, big is likely to happen. I'm not quite sure what it is. Interest rates are due to go up in 2015. I've been predicting this in FX Street for, 6, 7, 8 months for the UK. And when that happens, you have to think about how much money, people have actually borrowed to stimulate the economy and, to keep it going forward. Is all our growth figures right now are stimulated by individual personal spending. It's not by natural growth that we try to stimulate by the lower interest rates and, by having favourable conditions for business. So something's got to give. It's just common sense. It doesn't really matter how you look at things. All these, all this positivity, it doesn't get, just wiped away by the Fed, pumping in, 10, $15 billion a month to stimulate the economy. That's gone now. The US, the Fed have said they're going to be committed to taking away that stimulus, and that's going to be finished by the end of the year. So what replaces that? Where does that money come from? Where does that stimulus come from? I mean, as I said, it trickles through from the US through to the wider economy. So where do we build that up from? I don't know. Anyway, before we start, need to read the risk warning. Remember that spread betting is safe trading for high risk or capital, losing losses exceeding risk deposit. Very suitable for everyone, so please ensure you play into the risk involved. The information comments provided here in all circumstances considered offer a solicitation to invest. Nothing here should be construed investment advice. The information provided is believed to be accurate the data is produced. Again, education only. Content of the webinar is posted with the moderator at trader.com. Content is not constitute financial investment advice. Trader.com is not any liability to the content of the So as always, what we're going to cover is live charting analysis. So I'll go through the different time frames. I'll go through some products that I like to trade. So right now we've got gold, the euro dollar, and the FTSE. Fundamental analysis, well, that's what we're looking at right now. We're looking at how this GDP figure will ripple through the markets and probably make some difference to today's trading. I mean, again, as I said, we're looking at these growth figures right now. So inflation, CPI, PPI, all the figures that, revolve around that are not that important, but growth figures are massively important. And GDP is the broadest spectrum of how any economy is performing. So when it comes down to figures and understanding them, you don't have to be particularly, economically biased to understand that GDP is the figure. So GDP good, stocks go up, bonds go down. GDP bad, bonds go up, stocks go down. It's as simple as that. Okay, so GDP for me it's a broad enough figure that, it's an opportunity to trade, but it's a well publicised and figure that we can focus on that means that something's going to happen. That's why I'm here today trading it. So we'll go through some charts right now. So gold, as I've said, and I've been tweeting about, it's going to get down to 1279. Said that for the last, 2 weeks. The the fact of the matter is we're in a simple H1 formation where the market is working in the Fibonacci's. So I don't know. I mean, I get a bit tired sometimes of going over the same kind of things, but I can only stick to things that work. Fibonacci, okay. So from the high point in the market on the H1, we find a point of attraction on the 50%. Okay, so here the market is already deciding this is a key level or not. Gold's going down. Okay, I wrote about this in the FT 6 months ago. The fear and greed is out of gold, so it's coming down. So the market goes down, tests these fib levels perfectly, and it comes back up to the 50%. And again, that is a key point where the market has to either make a decision, either going back up to higher levels, or it's going to close below it and make new lows. So I don't know. I'm astonished sometimes that I have to keep going over the basics and not be able to kind of reiterate how important things like Fibonacci are. So that's a massive point of attraction in the market. Comes a massive point of attraction in the market once again, and then we go lower. So we're right below the 423.6. So the Fibonacci for me retracement has done its job. It's it's even come back to touch it. So what was support became resistance, and again it's trying to break above it. So right now gold is going to get down to 1279, 1261, and then probably 1226. So this is the Fibonacci on the hourly telling us that we've kind of run out of buyers. So all we have to do now is test the lower boundaries in order for gold to then find some buyers and push back up. How far it push back up? I don't know. I mean, there's a lot of speculation and talk about Russia and the Crimea being the next kind of Cold War. I was actually meant to be in London this morning on CNBC, but they cancelled at the last minute. So I'm not. Instead of doing that, I'm speaking to you guys. So yeah, there we go. I mean, gold is one of these things. For me, it's finished the upcycle. I mean, look at the weeklies. We're finished. Gold's done. You're going to tell me that gold is going to get back up here? No way. Just do a Fibonacci. I mean, just do the things that work. Okay, 50%. Yeah, if gold's going to get back to the 50%, for me, personally, I've done it by now. So really, once we close below this 23.6 on the monthly, we're going to get back to all these levels, break through, and gold gets down to 1030.85, then below that, down to, down to the, the kind of double figures. So, simple as, I mean, it's looking at things in the right kind of way. I mean, if you put that Fibonacci on the weeklies, then you can see how it's happening. I mean, these things, Fibonacci is great. I mean, I love it. It's amazing. How can that Fibonacci tie in with that weekly support level? How? Because it works. So we've rejected the highs, we've come back down, we've broken on the lower Bollinger Bands, 50%, been and gone, bang. 38.2, resistance. Nobody, can tell me that that's not resistance. The market has found significant action around here. 1, 2, 3, 4 months. 4 months it's told you it wants to go down. It's rejected closing above that level. Then we go down. Market is 23.6. Gets to the zero. So for me, market breaks to zero and gets down to these lower levels down here. I mean, I won't be surprised. I mean, I've said this in FT for 6, 7 months now. If gold doesn't get back to I don't know. I think for me personally, I think about $96. $96 is where gold's going to get to. But again, it's using these time frames, these charts, for the kind of the more interesting trading opportunities. So you can look at the monthly, weekly, daily, and that's all fine. But if you're looking at the hourlies, then look, I mean, these monthly fibs are still playing a part. We've found significant resistance on the hourly chart from the monthly. We've consistently made lower lows. So once we break through all these levels down here, the market wants to get down to 1186. So if you want to get short gold now, you've got 63 tick stop there. 110 ticks on the downside, or 1,000 ticks. 630 ticks on the upside. So I mean, huge amounts of potential to get involved. Euro dollar, again, I've been very negative the euro dollar for a long time, but yes, again, I mean, 50% Fibonacci. I mean, it's very hard to kind of, argue against these hourly kind of technical signals. Market finds a massive point of support resistance. We can't bounce up 50%. So when it finally breaks through, we try and get back above it, but we can't, close above it. Market then drifts down. So I've always been negative. The euro dollar, I've always been a big seller. So for me, euro dollar hits 1.32797 and then gets down to 1.36. That's where I'm looking for it to break. And then there's loads and loads of support down here. So this is where the market's going to get down to. FTSE, again, something else to keep an eye on. I've stopped trading the S&P right now, just a little bit. I don't know. There's too many institutional players in there, so I'm not a big enough trader, unfortunately, to kind of deal with the moves in the S&P. So I'm staying away from it. I'm focusing more on the FTSE, a little bit of DAX, maybe even a bit of a CAC, a bit of a CAC trading. So again, 50% on the hourlies. There we go. Can't really argue with the stats here. So as we close with a 50%, all these down fibs are a target. So we've got one or two things. We're either going to hit 6550.61 and then get down to these lower daily points of support, or the fibs run its course and the buyers come back into the market, we bounce off and we target all these and make a new high. A lot of things in the market about China liquidating dollars and buying the euro. Lots of speculation about what's happening with the world banks and etc. etc. Fact of the matter is, we don't know, do we? So yes, Forex Gal, good to see you. Gold might rise if there's a bad GDP. Absolutely. I think there's nothing more certain than that coming right there. Gold goes up on bad news, it goes down on good news. So yeah, fact of the matter is, in just over 18 minutes time, we're going to have some new fundamental data, and it's going to affect the markets in one or two ways. It's either going to buy on fear, or it's going to sell off on good news. Simple as. So, any other products that you guys want to go through? I mean, to me right now, I'm kind of neutral. I'm not expecting anything major from the GDP today. I mean, it's not particularly exciting me. So, I don't feel like good GDP or particular. So what do you guys think? Yes, sorry, Mr. C. What's the brief? Okay, well, the brief is the same as always. We've got some live data at 12:30. So good GDP, stock markets go up. Bad GDP, stock markets go down. That's about as simple as we can make it right now. The whole kind of backstory right now is that we've got the fundamentals, problems in Crimea and Russia. As I said, I mean, the sanctions imposed by the US and the EU are fairly limited. It affects 30 people in the kind of offshoot, and then the imposed sanctions that are worse only affect 100 people. And these are people that, again, I mean, it's very hard not to sound a little bit big-headed, but I know some of these people. I know some of these Russian billionaires that have been targeted. I'm fortunate to live in a place where I get to rub shoulders with a lot of rich people. I don't live too bad myself. And that's why it's kind of interesting when you listen to the so-called little people and the experts, people that make the money out of being, writing, nonsense stuff in nonsense kind of publications. I live the dream, I do what I do because I like doing it. If I didn't like doing it, I'd stop doing it. I earn enough money not to ever have to worry about anything. So I do these seminars and webinars because I get great interaction. I get people that follow me. I get the opportunity, to talk about whatever I'm interested in. But you have to look at the bigger picture. It's not the little people that are making the world move right now. It's the big people. We've got companies that have more wealth, more money stored away than countries. Individuals, people like Warren Buffett, Bill Gates, that have more money than countries. I mean, the world's a messed up place. It's a messed up place. But you have to understand what moves the markets. So we're talking about figures right now. Figures right now, like the GDP. That's why I'm talking about it, because it's not just me that's interested in this. It's people that move the market. Institutional money, people with pension funds, hedge funds, really, really big traders we're focusing on this. So it's not that they want to trade the actual figure itself. Good news, buy the S&P, bad news, sell the S&P. You want to get into better positions. So that's why you see that initial 5-minute candle spike up or down. And that's because these institutions are manipulating their positions around that quick bit of volatility. So for me, it's good GDP. Gold, well, it's a bad GDP. Gold might spike up, back to these upper fib levels. But that, for me, would be a massive signal to sell, because the real trend of gold is down. All the real fears out in the market. So bad GDP, it's expected 2.7 today. Maybe it comes at 2%. Bang. Spike up, 80 ticks, and then all the big institutional sellers buy it back up, and then sell. Sell, make a new low. That's how real traders work. Well, what was the next sell in gold? Well, I've said for maybe 2 weeks now that 1279 is the target. So it makes me laugh, that people say, no. It's very hard sometimes to kind of keep a level head with these things. But I've been short gold since I was caught in the FT about, 6-7 months ago. So it's not that I know more than other people. It's just that, you have to understand that, supply and demand. There's no physical shortage of gold. Gold is not something that we have to have in our lives. You can buy platinum, you can buy a different wedding ring. Gold, is used in manufacturing, but realistically, it's a very tiny, tiny commodity. It got bought up from fear. The fear's kind of gone. With the fact that the Fed are tapering QE means that the fear is gone. So once we've hit these levels here, the market really is tested back down. So where would you get short gold now? I would say you would get short gold. Very difficult to say, where you get short gold. Unless you're short gold, I think probably you're going to get in a very difficult position. So unless you're already short, there's no real opportunity to short gold apart from getting short now, letting us break these short-term support points and getting down to 1279. And realistically, gold gets down to 1186. So on the downside, there's still 1,000 ticks of downside. But if you're doing a 1,000 tick trade, then you need to have 200 tick stop. So gold can get back to this 1316 level, and test that as kind of support resistance, and then get back down to these lower levels. So the point and the fact of the matter is, for me, when you're trading, you've got to look at what the market can do against you before it goes in the wrong thing. So for me, market can push up back to this lower fib level before coming down. So I don't know. It's very difficult to know where to get short now if not already short. Yeah, but where would you get long? I mean, we're just at the lower end of the Bollinger Band here. Made a couple of wicks, but, we haven't done anything significant. There's no profit to be had long in gold here. None at all. What you'd want to do is see the market sell off to here, and leave some sort of wick, and then buy back at these levels. The market to get back to the moving average. There's absolutely no value buying gold. No value at all. If anything, stay out of gold. Simple as that. Look at this formation in the euro dollar. Market's tried to break these lower levels, get down to the fib, rejected, closed above it, made highs. Yeah, that's what you're looking for. These kind of scenarios like this. So you'd want the same thing in gold to happen before you buy it. Otherwise, you're just buying into weakness. It makes absolutely no sense. Okay, guys, well, 12 minutes for the GDP. We're expecting a figure of 2.7 today with a low of 2.2, a high of 3%. I can't see the 3% happening, so for me, my natural bias is slightly negative. Any of the products, we've got 10 minutes or so for the figure. Anything you want to go through? Any products? Anything else? Like I said, guys, I mean, I'm partnered up with the FX Street, so I'm selling, I do sell these charts. I have, quite a few users already of people that want to see the markets as I interpret them. It's not just me as an educator and presenter, this is how I make my money. I don't make it by presenting on FX Street, to be honest, it doesn't pay me enough money. I do it because I've done it for 3 years, and it's the best way of, interacting with as many people as I can. And having that, very important credibility that people are, searching for. So the fact of the matter is, the 50% is what you look for as a day trader. That's what you have to look for. Your hourly signal are much more significant and important than anything else. Maybe trade you 15 minutes as entry, but your hourly signals, they don't lie. I mean, look at this. I mean, the UK, the FTSE 100, what made this Fibonacci extension 50%, 100, 161, 238. It's brilliant. For me, Fibonacci is the only tool that I like because it relates to life, relates to nature. The reason why your forearm is the same size as your foot is because of Fibonacci. It's proportions, it's levels. And you can't take them things away from irrational markets. Sometimes the markets move very quickly up, very quickly down. But if you've got something to hold on to that works in nature, that has been around for about 500 years, I'd stick to that rather than newfangled, things like Ichimoku clouds and all that kind of silly nonsense. I've been a trader for 10 years, over 10 years. I've managed some of the biggest traders in the world. In fact, I'm writing books at the minute, I'm the chief market strategist for Intertrader. I've written software for, MT4. I'm the biggest selling software provider for Metastock. Why would you listen to anybody else? I live in the Channel Islands. I've lived in tax havens for 10 years. 10 years. Okay? Why do you think that is? It's not off my salary from Intertrader. It's because I know what makes money. And it's these things. It's charts. It's technical studies. Technical analysis. These things make money every single day. Okay, anything else you want to go through? Dollar, Japanese yen. Okie dokie. Well, seeing a very big bid come back into the dollar yen. So again, this is what you're looking for. Yeah, the lower Bollinger Bands on the hourly. Market's tried to push aggressively down. Doesn't. Yeah, close towards the low. 101.822, daily support. Close inside it. Get back to that level. Yeah, in 1, 2, 3, 4 hours. Find support on that. Bang, 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 bang. So before, for me, we're going to test 102.398. If we don't close above that and, try and make these new highs, we're already outside the Bollinger Bands now. The market then goes back and tests all these lower points. For me, the dollar strength doesn't go away. I mean, everything in the commodity-wise is priced in dollars. So look at the dailies. Support, support, support. We've gone from the up to the downside, and we've kind of finished that down. So, again, use your Fibonacci. I would say the up move for me starts down here. Get to the highs. Sorry. Low. Well, okay, then. Let's do it. The low move for me starts here. Gets to the highs. Down, 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 down. Where's that 50%? Here. Okay, there we go. Don't close below the 61.8. Don't really kind of significantly close on the dailies below the 50%. Market then goes up. So for me, we can only make new highs. Simple as. The dollar will increase in strength. We get down to these levels up here, and then we hit 105 and make new highs. Okay, this is daily chart. Okay, so we're going to close below the 50% significantly here. Yeah, we'd have done it. Tried here, reversal, doji. Tried here, reversal, Tried to break lower from this 101.822. So the market now hits the 38.2, 23.6, and makes a new high. So simple as. Dollar makes a new high against Japanese yen. Look on the hourlies, same scenario. Top of the fibs here, the 50% is going to pivot 102.398. Close above that, yep. The dollar gets to 102.827. Easy. Easy. Charting's easy, isn't it? I love charting. It never lies. Okay, anything else? We've got 6 minutes for the GDP. Anything else you guys want to look at? You want to go through? Ask me any product. Well, yeah, I mean, easy peasy, Japanese. I mean, it's very hard for me sometimes to kind of convey how much effort has gone into making my software, into being the chief market strategist of Intertrade, of just being involved in the markets. It's a very lonely life, a very lonely life. People only care about you when you're right. They don't care if I can to to support myself and my followers and my work on FX Street and Intertrader, to make things as easy for you as I can. The fact of the matter is the markets are difficult and hard, and if you're not looking at the right kind of time frame, your chance of success is nothing. So unless you're looking at the hourlies and the 15 minutes for your entry, your chance of being right more than you're wrong is literally less than 1%. But if you understand Fibonacci, higher time frame levels, the way I look at the charts, you've got a fighting chance. And it might only give you a 50% chance, but I tell you what, nobody else is giving you a 50% chance. Okay? I'm probably saying I've got 80% edge on most traders. And that's enough for me. And even I still lose money sometimes. So that's how difficult the markets are. Forex Gal, 5 minutes for news. Well, that's perfect. That's exactly what you should be doing. Remember, news spikes are, a quick new bits of information into the market. So that's absolutely perfect. Yeah, that's good to hear, Forex Gal. But again, I mean, what I would do is if you personally, is try looking at the 15-minute chart for your boundaries and then your 5-minute chart for the spike. Now, I do lots of signals. I do lots of technical analysis myself. And for me, if the move is big enough, then it will take 15 minutes to filter through the market. Okay, so 5 minutes is a little bit too short for the overall move, but it's perfect for the initial spike. So if you're just trying to trade the first 5 minutes of the news, that's perfect. But remember that, it's going to take 3 more 5-minute closes to make a 15-minute, then 4 15-minute candle closes for an hour. And that's when the market filters through. So the initial spike, 5 minutes is perfect. I 100% agree. But if you're trying to get the continuation or reversal of that 5 minute, then look at that on the 15-minute. Okay? Just trying to help you. I mean, Forex Gal, you've followed me for a long time, and, I always look out for your name. So, you're clearly somebody who's interested in the markets, and I love to see consistent followers. So I'm only telling you things that I think will help you. The first 5 minute spike, as a trader in non-farm payrolls, you're going to get one or two things. That first 5 minute spike, up or down, is going to retrace to the 50%. We're going to make a new high, or close below it, or retrace 100% of that move. That's all it can do. The first 5 minutes is absolutely key in data. It's absolutely key in data in the markets for two reasons. First thing is, majority of people trade on spread betting platforms. We're not direct market traders. So when we're getting into the first 5 minute candle, which I don't advise, but we do, because we're naturally impatient. We're getting into trades as professional traders are getting out. That's why people lose money. Wait for the first 5 minute candle to close. You've then got a 50% pivot where the market's going to continue the initial spike up or down, or it's going to retrace that initial volatility. Simple. It can't do anything else. It can't do anything else. It can't. That's what's so very vitally important about that first bit of volatility, because you've got people like us, 2 minutes time waiting for GDP. Okay, I'm trading with, whatever I've got in my account. There are people sat around trading GDP with a £10 million account, a £100 million account. So that first bit of volatility is the spike you don't want to be involved in. All right, guys. Well, listen, we've got 2 minutes before the GDP today. So GDP is expected at 2.7, a fairly broad range for me. 2.2 on the low side, 3% on the high side. Previous figure of 2.4. GDP is the broadest spectrum of what's really kind of happening in the markets right now. So high GDP, we buy the stocks. Low GDP, we sell it. But I keep an eye on gold right now, to be honest. Gold's my kind of risk. As I said, I've been negative gold for a long, long time, and the fact that we're below the 423.6 retracement means that it's 1279. It doesn't matter what you think, or what you think of me, or what you think of technical analysis or fundamental analysis. Gold will hit 1279. Okay, that is inevitable, absolutely inevitable. And what it does from there, either buys back up or it sells back down. So good GDP, we get down to these low levels. Euro dollar. Again, thinking about trading the euro versus the dollar, a bad GDP will send the euro dollar up, okay, because more people buy euro over dollars. UK 100, I'm keeping that around the S&P because I just don't want to trade the S&P right now. So a bad GDP will sell us through this 423 and 6490 spot 50 is the big level. All right, guys. Okay, data's coming through. Nothing really of interest, to be honest. Really, the comments talk about, good inflation and competitive stances. Euro's going down, so slightly better than expected GDP. Yeah, so retail sales jump. So, we're going to see basically gold's going to test this lower level of support here and then maybe get down to 1279. Euro again is selling off, better than expected data, but nothing major, to be honest. I'm just listening to the score now, guys. I mean, nothing major is going through that data. Yeah, I mean, inline data, remember, it's, when we're talking about, 0.1%, it's not really kind of anything major, so, yeah, I don't know. It's a bit boring, to be honest, sometimes. Sometimes the data, is a massive anticlimax, that's why it's boring for the markets, is we're always striving for that bit of, information that shocks the market and gets people in, out of positions, but kind of inline data, just 0.1% down of what we expected. Doesn't really give us a lot of kind of target to go at. So I would say one or two things going to happen for me. I'd say the euro is probably going to test these lower levels before it spikes back up. A lot of people are still long the euro. So there's a lot more positive bias. So all these down points, people are going to buy back. So I'd expect the euro probably to hit these lows here, get down to the lower fib of this 161 and then bounce back up. Even though I would never buy the euro. So massively negative. But I would say that that's what's going to happen for me. We're going to make new lows in the euro and then I buy the lows. Yeah, FTSE's kind of taking a little tiny bid on the back of that inline data, but it's in such a tight range, to be honest. I don't think that's good enough data to send it up. And gold, you'd expect gold to take a slight sell-off, but realistically, it's not happening. Okay, Forex guys saying, there's always the markets open to trade too, 10-year note down, gold stalled, when buy the lows in the 15 minutes. Okay, I think I kind of understand that. Okay, well, I mean, you can see from gold, we've seen 0.1 bad data, so you'd expect gold to go up. So you've got the decision point, which is the moving average. So rejected lower, rejected lower, rejected lower, rejected lower, rejected lower. So gold naturally has to go up before it comes down. So realistically, on the 15 minutes, we've only got 1310.50 as a target point. So gold on that slightly worse than expected. It has to buck the trend of going down, okay, and then get back into all these red candles and get up. So gold's going to do one or two things. It's going to get back to here, 130.07 or 1310.50. That's all it can do. But again, it depends on how long you're willing to hold a trade for. So they're going to go up 76 ticks or 150 ticks. Or for me, more likely, it's going to get up high, maybe to 130, maybe break into this range here, and aggressively sell back down to 1279. I mean, it's pretty much inline data. It's the GDP is not better than expected, not a lot worse than expected, pretty much in line. So, why would you buy? Why would you buy that figure? Why would you sell that figure? You wouldn't. So what we're going to do is let the market be manipulated by short-term speculators, push up to resistance, and sell back down. Okay, am I buying the lows in the euro? No, I'd never buy the euro. I told you. My view is I'd always sell highs in the euro. I stay at the euro unless it's spiking up. I only want to sell the highs. I don't have to trade. I've got enough money, so why would I buy the euro? I'm not interested in buying the euro. I'm interested in selling the euro when it's high. That's what I understand. I only trade what I understand. So I'd sell the euro back at the 50%. I wouldn't buy it even though I'm pretty sure it's going to go up. I wouldn't buy it because that's not what I want to do. I want to sell it high and sell into that weakness. Anything else, guys? Anything else? Got the data's come out. It's done nothing to the markets, to be honest. So, that's already gone. That data now is instantly discounted. The first 5 minutes would have told us if anything was going to, spike on the back of that data. As I said, it's not non-farm payroll, it's only GDP. So sometimes it just doesn't work as we want it. But, that's life. I can't always guarantee the exciting sessions. For me, as I said, the gold, I'd sell highs in gold. So, a slightly worse than expected figure. I might sell gold back at the moving average or the top of the bowl. Euro dollar, it's not doing anything. And then the FTSE, kind of whatever gains it just made off the back of that data, is already looking negative. So I'd say if we break below 6,550, spot 6,1, then we're going to get down to 6,490 and a half. I mean, that's for me. The worries in Crimea, the worries in the world. The fact of the matter, the data out of everywhere is not great. Means that I'm a little bit of a bear. To be honest, I'm a bit of a bear for the stock market, a massive bear for the euro, and as for gold's going to get smashed. And if gold doesn't reach $1,000 by the end of the year, then I don't know. I don't know how to quantify the world if gold doesn't get back down to $1,000. If it doesn't, then the world is fundamentally broken and we're all doomed. Okay, that's my gauge of things. If the gold doesn't get back to normal levels, then that means there's enough fear in the world to mean there's going to be something major, like nuclear Armageddon or Bitcoins become the currency of choice. If gold doesn't get back to a fair level, then there's still too much fear in the world. That means something big's going to happen politically. And it might be Russia, might be the US defaulting on loans. I don't know. But the gap now in London is so big, I don't see how it's going to end well. 5 families in London have more money than 12.6. History's told us when the wealthy gap divide is so big that bad things happen. Okay, just history, not me, not anybody else, just history. So it's the biggest it's ever been. That can't be good. It can't be good. So sorry to always sound negative on things. No, I'm not negative. I've got a great life. I don't care. I've got loads of money, so I'll do whatever I want. But for the rest of the people in the world that aren't rich and don't live in tax havens, they're in trouble. Simple as simple facts of the matter. They're in trouble. They're in a really tough situation where interest rates, once they start going up, your mortgage, all the credit cards you have, all the things you have in higher purchase become exponentially more expensive, and people don't have the money. Full stop. So it doesn't matter if interest rates go by 0.25%. 0.25% is like things doubling. Simple as, it's very, very difficult for people to understand the bigger picture. But, if you've got a £500,000 mortgage, the average house price, in London is £600,000. So it doesn't matter where you're in the UK. If you get a 0.25% basis point rise on your mortgage, that's a lot of money. Okay? Interest rates for me, by 2020, will be at 5%. 5%. And people will laugh at me and go, oh, no, they won't, Steve. Okay? Back in 1980, when my parents were buying houses, interest rates were 13, 14%. And they were earning no money. Rubbish money. Compared to real terms now. But the average house price back then was 10 grand, or whatever it was, 15, 20 grand. It's all relative. So interest rates are going to play a massive part in the markets. Yeah, a massive part. And I tell you right now, there's something like 5 million people in the UK with debt they can't sustain. So what's going to happen when interest rates get to 1%? You tell me. Nothing good. Nothing good at all. My view on the GDP is going to go up, Vincent. I've been very bullish the GDP for quite some time. Again, anticipating that out of the G8 or G7, I'm not sure, been suspended. That the interest rates are going to be favourable in the UK, so money's going to pour in. And like I said, I mean, something bad will happen to the UK, something bad will happen to London. It's just one of these things. It's just a bubble waiting to happen. You can't have the average price, of a house in London at £600,000, and the average wage is something like £35,000. Who's going to borrow, 20 times the salary? Who can responsibly do that? Nobody. And the amount of money that a certain generation have tied up in money will get relinquished. It always does. I mean, I dread to think how many houses my parents have got, but when they die, I'm going to get it. You know what I'm going to do with it? I'm going to spend every single penny. So I'll be about 60, 70. What use is the money to me by then? None. So I'll blow it. I'll buy more Ferraris. I'll do more stuff. I'll just, whatever. I'll just spend it. And then that will happen throughout the generation. So there'll be a big 70s style summer of love. You know, people get money they never had. And the money will come back into the economy. But right now it's tied up. And we can't do anything about that. There's £3 trillion tied up in property in the UK. And until something happens, i.e., you know, these people die and leave it to the families, you know, it's not going anywhere. And that's what's keeping the price of property artificially high. And the government are doing very little to stimulate, you know, affordable housing because they're so petrified. They don't know what's going to happen when property prices initially fall, which they have to. It's simple. We're making more people, but who's going to go out for your first house with your student loan of 30 grand and then go and buy a £500,000 house if you don't have help? How are you going to do that? No matter what you do, you're not going to go from university these days with your degree in Barbie or, you know, David Beckham studies, Spice Girls, whatever it is, and go and get a job for PricewaterhouseCoopers on 50 grand a year. I did that. But I'm an exception. I'm one of the smartest people I know. So I afforded myself certain luxuries. But there's not many people like me. You have to go with the masses. You have to go with the masses of, you know, what society's doing, what, you know, society's telling us. And the fact of the matter is that if you're getting on the housing ladder right now with a lot of debt, you don't have the 20% deposit. You don't have 50 grand in your back pocket to buy, you know, yourself onto the property ladder. So what's going to give? Yeah, something's going to give. Yeah, I mean, things more renting. I don't disagree with renting. I think it's a good way for people to live. I mean, I rent currently, to be honest. Why would I buy? You know, I've got enough money to do whatever I want, but I rent because I know what I'm going to pay out in a year, and it box off. So I know what I'm liable for in a year. I don't have to worry about interest rates going up. I don't have to worry about mortgages. I don't have to worry about anything. You know, I live on the beach. You know, I've got a penthouse flat, and it costs me what it costs. Oh, it's a lot of money for most people, but there's no fear. Okay, no, absolutely no fear to me. So that's how I live my life, with less fear. I know that I can pay my rent dead easy every month. It's of no danger to me if property prices go up, if interest rates go up. So that's how I live right now, with no fear. But it's different for different people, isn't it? I mean, I've got other things to worry about. I've got business ventures. I've got, you know, things I do. I've got software. I've got blah blah blah. You know, loads of boring stuff. But I don't want the fear of kind of my interest rates going up and my mortgage payments going up by, you know, £300, £400, £500 a month. I don't want that. So I don't put myself in that situation. Thing is, you know, a lot of people, you listen to your parents, don't you? So a lot of people that are here, you know, that are 30, 40, 50 years old, all your parents have done is bought houses and made money. That's all they know. My dad's a classic example of that. Bought a house for £250,000, it's worth £1 million. And then last year, he remortgaged it for £1 million to buy another business. Yeah, he's 60 years old. He can only do that because his property's gone up. He's not a smart guy. He's stupid. And I told him he was stupid. But there we go. He can afford to do these kind of things. You listen to your parents. Listen to the people that think they know what they're talking about. They don't. Okay? They've just lived in a place where you've had, you know, the UK, you know, full employment, where your wage have gone up. You know, you've got your fat pension. Blah, 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 blah. Yeah, that's not going to happen for me and you. By the time we retire, there'll be no pension. Yeah? Is my house, if I bought a house tomorrow, going to go up 10 times in value? No. Okay? So that is gone. Them days have gone. So all our parent generation of buying houses for 10 grand, 15 grand, and looking at 100 grand, blah, 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 you know, hyperinflation. That's gone. That won't happen for us. That won't happen for, you know, people 21, 22, 23 coming out of university. Them times have gone. Yeah? Who's going to buy a house for £500,000 in 5 years and worth £1 million? Not going to happen. So unfortunately, all the good time, all the money's gone until the, you know, the money filters through back to, you know, the generations. There's nothing we can do. So, you know, there'll be a massive readjustment. There always is. I mean, it's not, you know, you don't have to listen to me. You know, it's whatever. It's history tells us these things readjust and, you know, come back to the norm. That's just the way the world works. So whatever money's in property right now will be readjusted. Look at Germany. Look at New York. The majority of people rent. They don't buy. They rent. That's normal for most people. It's only England where your king is your castle. And people have used it for a savings account, deposit for your retirement. It's wrong. It's wrong because people need to live in houses and move up the chain. So if people of a certain age that buy many houses and rent them out and think that they're not doing anything wrong, well, they are. Because they're taking houses away from people that need it. So just because you watch Homes Under the Hammer and you're, some 50-year-old retired teacher retiring on your fat pension, you bought a house for 100 grand that's worth $500,000. So you bought 2 terraced houses with that and you do them up and you rent them out. That's not right. Yeah? And that will change. That will change. It will change when interest rates go up and people die and the money goes through. For me, what's the point? What's the point in a world where people can't afford to have a decent house or, have to pay over the odds for anything? These things are not good. They're not good for motivation. They're not good for the society. And what's the point of relying on your parents because they've accumulated all the wealth by accident, by pure accident? Nobody, back in the 70s or 80s was looking at property, as they do now, as, grand designs, all this kind of stuff. They just bought houses because that's what their parents did. But now they're the ones sat on all the wealth and, on all the money, and people, young people can't buy houses because it's all with their parents and their parents' generation. Anyway, there we go, guys. So for me, seller of gold, with any highs. Euros still, I'd probably buy the euro, although I wouldn't because I'm negative. It still looks like these lower levels could be a good buy. And, the foot's just looking weak. So a break of 6,550, we could see a big sell-off. Big sell-off if we break the lower bowl back to these lower levels. Alright, guys, like I said, you have to, if you want my kind of charts, that I do offer this on FX Street. So just look for me on FX Street and look for my iView charts page so you can get involved with the charts the way I trade them. But my fundamental views are different from most people because I'm a cynical person, but I can't help that. That's just the way the world's made me. But realistically, the FTSE is looking weak. Got some big tops. I would, probably buy any dips in the euro and then sell any highs in gold. That's just my view at the minute. That's just what the charts are telling me. Anyway, guys, it's been an absolute pleasure. As always, thanks to Vicky Moore and the guys at FX Street. Anything else you want to ask me, at Steve Ruffley on Twitter. Alright, guys, it's been a pleasure. Have a great afternoon.